Being a value investor can feel like a lonely road. I was there. I was the hype person 20-some years ago. I was the person that couldn't stand it if my friends did this in investing or my dad's friends made X investing. I'm like, oh my God, how am I missing out on this? Then the dot-com crash happened. And I was like, wait a second. I bought all these companies because the internet's the future. How are they all going to zero? My sister's boyfriend's father told me to buy Global Crossing. And I'm not blaming him. I made the decision. It went to zero. It was a scam. But I believed him. Why? Because he was in the world of telecom. He said, I've got an inside track. I know this is the company for the future. The CEO was the fastest ever at that point to $1 billion net worth in like 11 months. And I was like, oh my gosh, I can't miss out on this. I absolutely can't miss out on this. But then something happened. The market crashed. And I was like, boy, what happened here? Now, I didn't have the internet back then. I didn't have channels like this. I didn't have videos like this to look at. So if you're new to this channel and you have this video, I'm Paul, and I really encourage you to stay because I'm a value investor. And even though it can be boring, it makes perfect sense. And what's more exciting is when your stocks are up better than everybody else's, and more importantly, when they're not down as much as everybody else's. When you're buying stocks that are undervalued because you have the right process for understanding the most important part of investing in stocks. When you buy a stock, you're buying a piece of a business. But the stock price and the business are very different things. Mr. Market's going to tell you all day long how much the market perceives the stock value the company's value to be by changing the stock price daily. You have to decide, are you a buyer or seller of the stock? That's the big key. Go look at all the high-flying stocks that are down 70, 80, 90% in the last year. These are companies that everybody loved at $300 a share and hates at $30. Does that even make sense? By the way, I was being ridiculed because I said I wouldn't pay 1/10 the price they were at. Paul, you don't get it, they're not going to fall. Oops, what happened? Because there's a process to it. Now, will I miss out on some big ones? Absolutely. But my journey has been that I would prefer to get the singles and doubles than the once-in-a-lifetime grand slam home run opportunity. That's more important to me because the singles and doubles get you on base, and when you get on base, you score. That's the key to investing. I got caught up in the dot-com. I was young. I was in my high school calling the Akron Beacon Journal for my stock numbers. Everybody was making money. Everybody was talking about it at school. We had kids talking about it. We loved making money. That's all that mattered to me at the time. And then when it all came crashing down, I still stuck with it because I liked investing and everybody else gave up on it. And that just really confused me. I'm like, wait a second, we're investing. And I didn't realize back then what I realize now, that was the sign that things were bad, that everybody was making money. I just thought everybody was really good at investing. No, that is not possible because in order to beat the market, you have to be different. And if everybody thinks different, then nobody thinks different. That is the key here. Think about that statement again. If everyone thinks different, then nobody thinks different. That is a big key here. And what I'm trying to relay here is the more you learn, the less you fear. I used to fear stocks going down. Now I absolutely embrace it and love it. Nothing makes me happier than seeing the market down. Why? Because I just start going into my account and start looking at stocks that I like at lower prices, and I either buy them or I sell puts at lower prices so that I can take the shares from people at much, much lower prices. My goal is to buy pieces of companies for less and less money. I am buying a stream of cash flow for less money every single month. And over long periods of time, if you believe the world's still going to be around in 10 years, and you buy a good, diversified portfolio of stocks for a good ratio, you will make a lot of money. And you will beat the market. I remember, fast forward a few years, talked to a good friend of mine who was a big market investor. And I said, Michael, is it even possible to beat the market? I was even doubting it 15 years ago. He said, absolutely. Absolutely. He goes, of course it's possible to beat the market. And Warren Buffett and Charlie Munger always say, it doesn't take a genius to beat the market. It takes emotional fortitude to beat the market. Can you convince yourself that when stocks go down, it's a better thing? And every bear market will make you more, and every bear market and its recovery will make you understand that more and more. Just a year and a half ago on this channel, everybody, go look at our comments. Paul, you never like anything. You never like any stock. And you know what I say to people? There will be a time when the comments are saying, Paul, you like all these stocks and they keep going down. Yep. And I will keep buying as they go down. Now, will I reassess every month or two? Absolutely. A good investor doesn't sit there and just look at the price going down and say, I'm going to buy it. A good investor will sit there and say, is my thesis still correct? Am I still able to buy a great company and a great cash flow for a good or great price? That will happen. The Apples of the world will sell for a lot lower prices, and I will be a buyer at that point. The Googles of the world will sell for lower prices. When I look at where we are in terms of three major stock valuations, stock market to GDP, 10-year cyclically adjusted PE, and the price to sales ratio, this market has a lot further south to go. My journey along the way has made me realize that it always comes back. I've lived through three major bubbles now. This one, the real estate and financial market bubble in 2006 and 7, and the dot-com bubble in 2000. I actually think this is the worst one. Is it because I'm living it? Sure. But also the valuations have been insanely higher than both of those bubbles. This is the key here that I want you to understand. So if this is new to you, but you made it this far in the video, it means it's making sense to you. And I encourage you to embrace that. We have a community. Over 12,000, 13,000 people have set up this community since we started it. It involves all of our software that we have up here and allows people to understand that they're buying a future stream of cash flow. And what I didn't have back in my journey was people around me who I believed understood that. And we thought the same. This community has that. Has everybody in there to talk to each other, to understand when stocks go down, they reassure themselves. Guys, remember, we want stocks going down. Because it is a single and lonely road out there when you're in your neighborhood and everybody else is buying all the hype stocks and you're not. Oh, and by the way, then when they crash, they'll tell you, I sold it a long time ago. Because guess what? My buddies say the exact same thing today. Oh, I sold a while ago. When? Crickets. I don't hear it. Because they didn't sell a long time ago. It's just amazing to me how everybody talks about the times they perfectly bought and perfectly sold. That is a lie. What your job will be is to sit there like I do now. When somebody says to me, Paul, this is a great company. It's going up a ton. Great, have fun. You don't have FOMO? I have zero FOMO. I have zero fear of missing out. And I wasn't always that way. I had immense fear of missing out for a long time. But you know what I realized? The losses pained me too much. I didn't like the losses. The losses pained me much more than the missing out on gains of stocks I didn't understand and companies I didn't understand. So now my goal is I look at 10,000 companies out there and I pick the 200 or 400 that I understand and I buy the 20 or 40 that are selling for the price I want them to sell at. That is my goal. If I don't understand the business model, I immediately delete it. I don't even want to look at it. Now, somebody else might understand it because they're like, for example, banks. I don't understand how a bank's financial statements work. So what do? I eliminate all banks. Paul, come on, go learn them. I haven't found any. I found one person who could teach me, and he wasn't able to give me enough of his time to teach me because of his current job. So until he's able to, I avoid banks. And there's probably some big money to be made in banks with rates going up. I avoid them. And I'm fine with that because my journey has been understanding this whole process. There was a great book written by a guy named Guy Spear called The Education of a Value Investor. I love this book. It's one of the 10 books I suggest everybody to read because he talks exactly this way about all these people who say they're value investors, then stocks fall and they bail. And he would eliminate himself from the emotional tirades of the market. He'd put his Bloomberg terminal in a different part of his office with no chair. That way he couldn't just sit there all day looking at prices. That's a big component. Now, with me, because I like stocks going down, I have no problem looking at the market all day long. Because even if I like my companies, I have 15 companies right now. There's only one that I'm really like, am I really wrong on this one? I don't know. I'm not saying that I'm going to be right on 14. I'm just telling you there's one that I'm a little concerned about right now. And that's a good thing. What company is that? Carnival Cruise Line, CCL. And the reason being, and this is an important part of my journey, I made my thesis on CCL after the shutdown. And I said, okay, they have this amount of money, they can raise this amount of debt and issue these shares to get through the process. Since then, they've issued 10 billion more in debt than I expected, and they've issued more shares than I expected. That changes my value of the company. And that's why I'm wondering if I'm right or wrong in CCL. Now, CCL is also down 70% from its high in the last 2 years. So is it beaten up too much? That's part of my process. But debt is an important factor in valuing a business. And that's where I don't look at it and say, I love CCL and I think the cruise line will come back. The cruise industry will come back. The question is there too much debt with rates rising that will cause a problem for Carnival Cruise Line? Have they diluted me so much as an owner by issuing so many shares that even if they recover to pre-pandemic levels with less debt, is there enough to go around to give me my return? That is the question. That's what I want you to hear. I believe CCL will make it. I believe the cruise industry will make it. But did they put too much debt and issue too many shares that won't let it make it possible for me to see the return on investment that I expected? That's the important part. So if you like this video, there's two things I want you to do for me. One, subscribe to our channel. And two, go watch our next video on our 8-pillar process. You'll see all of the things we do to evaluate a company from the initial standpoint. Thank you very much.